Welcome back! Today we are unpacking the latest financial results from PC Jewellers Limited. They are a big name in the Indian jewellery sector. What can you tell us about them?
Absolutely. PC Jeweller Limited is primarily engaged in the business of trade, manufacture, and sale of gold jewelry, diamond-studded jewelry, silver articles, and precious stones. Their manufacturing facilities are based in India. They also have a few subsidiaries, including Luxury Products Trendsetter Private Limited, PCJ Gems and Jewelry Limited, and PC Jeweller Global DMCC.
Sounds comprehensive. So, they've just released their numbers. What period are we looking at?
We're looking at their audited financial results for the fourth quarter and the full financial year ended March 31st, 2025. The Board of Directors approved these results on May 25th, 2025. We have both standalone and consolidated figures to go through, which should give us a good picture.
Excellent. Let's kick off with the key financials, starting with the consolidated numbers. How did their revenue from operations look for the fourth quarter?
All right. On a consolidated basis for Q4 FY25, revenue from operations came in at 699.02 crore rupees. Now, comparing this year over year, it's a massive jump from the 48.49 crore rupees they reported in Q4 FY24. Wow, that's quite a turnaround.
Wow, that is a significant year-over-year increase. Now, how does that Q4 FY25 revenue compare to the immediately preceding quarter, Q3 FY25?
Quarter over quarter, the consolidated revenue of 699.02 crore rupees in Q4 is up from 639.45 crore rupees in Q3 FY25. So, a healthy sequential growth there as well. For the full financial year FY25, consolidated revenue was 2,244.60 crore rupees. Again, a substantial increase from 605.40 crore rupees in FY24.
Okay, impressive top-line growth. The report doesn't explicitly state EBITDA, right? So we'll use profit before tax or PBT as a proxy. How did PC Jewel fare on PBT in Q4 on a consolidated basis?
That's right, no direct EBITDA figure. So, looking at consolidated profit before tax for Q4 FY25, it was 96.47 crore rupees. This is a significant improvement from a loss before tax of 124.23 crore rupees in Q4 FY24.
A swing from a loss to a profit year-over-year is noteworthy. And the quarter-over-quarter PBT comparison?
Sequentially, the Q4 PBT of 96.47 crore rupees is actually down from 148.01 crore rupees in Q3 FY25. So, while revenue grew quarter over quarter, PBT saw a dip. For the full year FY25, consolidated PBT stood at 452.56 crore rupees, a strong recovery from a loss of 631.77 crore rupees in FY24.
That quarter-over-quarter PBT dip, despite revenue growth, is interesting. Let's move to profit after tax, or PAT, attributable to the owners for the consolidated entity.
Consolidated PAT attributable to owners for Q4 FY25 was 94.78 crore rupees. This compares very favorable to a loss of 121.64 crore rupees in Q4 FY24. Again, a major turnaround.
And what about the quarter-over-quarter consolidated PAT?
Quarter over quarter, the PAT of 94.78 crore rupees in Q4 is down from 147.96 crore rupees in Q3 FY25, mirroring that PBT trend.
For the full year FY25, consolidated PAT was 577.70 crore rupees compared to a loss of 629.36 crore rupees in FY24. And the earnings per share or EPS on a consolidated basis?
The consolidated basic EPS for Q4 FY25 was 0.16 rupees. This is up from a negative EPS of 0.26 rupees in Q4 FY24. Quarter over quarter, it's down from 0.29 rupees in Q3 FY25. For the full year FY25, basic EPS was 1.13 rupees, a significant improvement from a negative 1.36 rupees in FY24.
What about other income on the consolidated side? Was it significant?
For Q4 FY25, consolidated other income was 1.08 crore rupees, which is down from 11.05 crore rupees in Q4 FY24. Sequentially, it's also significantly lower than the 43.99 crore rupees in Q3 FY25. That lower other income in Q4 partly explains the quarter-over-quarter dip in PBT and PAT despite revenue growth. For FY25, total other income was 127.27 crore rupees.
That clarifies the quarter-over-quarter PBT-PAT movement. Now, let's switch to the standalone performance. How do these key metrics look for PC Jeweller on a standalone basis for Q4 and the full year?
On a standalone basis, the trends are very similar. For Q4 FY25, standalone revenue was 699.01 crore rupees, up massively from 48.49 crore rupees in Q4 FY24. Quarter over quarter, it's up from 638.73 crore rupees in Q3. Standalone PBT for Q4 FY25 was 94.89 crore rupees compared to a loss of 123.97 crore rupees in Q4 FY24. Sequentially, it's down from 146.29 crore rupees in Q3. Standalone PAT for Q4 FY25 was 95.11 crore rupees versus a loss of 123.97 crore rupees in Q4 FY24. And quarter over quarter, it's down from 146.21 crore rupees in Q3. Standalone basic EPS for Q4 was 0.16 rupees, up from negative 0.27 rupees year over year and down from 0.28 rupees quarter over quarter. For the full year FY25, standalone revenue was 2,243.25 crore rupees, PBT was 448.12 crore rupees, PAT was 575.09 crore rupees, and basic EPS was 1.13 rupees, all showing strong turnarounds from losses in FY24.
The standalone performance certainly mirrors the consolidated strength. Now, looking at profitability, what can we say about their margins?
On a consolidated basis for Q4 FY25, the PAT margin, PAT attributable to owners, divided by revenue from operations, would be roughly 13.56%. For the full year FY25, it's around 25.74%. These are healthy margins, especially the annual figure, indicating a strong turnaround in profitability. The standalone margins are very similar.
Were there any exceptional items reported either on a standalone or consolidated basis that might have influenced these numbers?
The profit and loss statements don't explicitly list any exceptional items for the periods discussed. This suggests the reported profits are largely from their regular business operations, which is generally a good sign for assessing underlying performance.
Let's touch upon the balance sheet. Any significant changes in assets, liabilities, or equity for both standalone and consolidated?
Yes, there are some notable changes, primarily driven by debt restructuring and equity infusion, which we'll discuss more when we get to the notes. On a consolidated basis, as of March 31, 2025, total assets stood at 8,412.31 crore rupees, up from 7,269.43 crore rupees. Total equity has significantly increased to 6,192.80 crore rupees from 2,931.35 crore rupees. Total borrowings, current and non-current, have come down to around 2,064.81 crore rupees from about 4,087.24 crore rupees. The standalone balance sheet shows a similar trend. Total assets at 8,376.90 crore rupees, equity at 6,157.99 crore rupees, and total borrowings reduced to 2,064.41 crore rupees.
That's a substantial reduction in debt and an increase in equity. What about their cash flows? Did the report provide insights here?
Yes, both standalone and consolidated cash flow statements were provided for the full year. On a consolidated basis for FY25, net cash used in operating activities was a negative 632.72 crore rupees. This is a concern as they used more cash in operations than they generated, compared to a positive 63.86 crores in FY24. Net cash from investing activities was 2.49 crore rupees. However, net cash from financing activities was a positive 687.69 crore rupees, likely due to the proceeds from the issue of warrants and shares. This inflow from financing activities helped manage the negative operating cash flow. The standalone cash flow figures are very similar.
Negative operating cash flow despite a profitable year is definitely something to watch. Now, PC Jewelry operates in the jewelry business. Does the report break down performance by different segments?
According to Note 12 on the standalone financials and Note 13 on the consolidated, the company states that in the absence of export revenues, the export segment has ceased to qualify as an operating segment. The Chief Operating Decision Maker, or CODM, examines the performance from the perspective of the company as a whole, which is jewelry business. So effectively, they are reporting as a single segment, and we don't have a further breakdown.
Understood. So to summarize the performance, it's a strong year-over-year turnout in revenue and profitability, but with a quarter-over-quarter dip in profits for Q4 and concerning negative operating cash flows for the full year.
Precisely. The annual performance is a significant improvement. The quarter-over-quarter profit dip in Q4 seems influenced by lower other income compared to Q3. The operating cash flow situation needs to be monitored closely to see if the profitability translates into sustained cash generation.
The report usually contains significant notes and details about events during the year. What stood out?
There are several crucial notes. First, PC Jewels entered into a joint settlement agreement or JSA with its consortium lenders on September 30th, 2024. As part of this, an interest component of 42.04 crore rupees was recognized as finance cost in Q4 FY25. The company didn't recognize finance costs for the first 9 months of FY25 due to the settlement process. This JSA also involved a preferential allotment of over 51 crore equity shares at 29.20 rupees per share to the lenders against debt of about 1,509.97 crore rupees in March 2025. This explains a large part of the debt reduction and equity increase. Second, the company successfully completed a preferential issue of fully convertible warrants, raising a significant amount, with warrants allotted in September and October 2024. Many of these warrants were converted into equity shares during Q3 and Q4 FY25. Third, the face value of equity shares was subdivided from 10 rupees to 1 rupee per share effective December 16, 2024. EPS figures have been restated accordingly. Fourth, the company shut down 3 owned stores during Q4 FY25. They now have 49 owned and 3 franchise stores. And fifth, an unpaid income tax liability of 81.26 crore rupees as of March 24, 2024 was adjusted against income tax refunds, and interest income of 51.39 crore rupees on these refunds was recognized in FY25.
Those are indeed significant events, especially the JSA and the warrant issue, which have reshaped their balance sheet. Now, this brings us to a very critical part, the auditor's report. What did AHPN and Associates have to say about both the standalone and consolidated financials?
This is where things get very serious. The auditors, AHPN and Associates, have issued a qualified opinion on both the standalone and consolidated financial results for the year ended March 31st, 2025.
A qualified opinion? That's a major flag. What are the specific qualifications?
There are 3 main points to their qualification. First, regarding outstanding export trade receivables amounting to 1,512.03 crore rupees as of March 31st, 2025. These have remained unrealized for an extended period. The company had provided discounts of 513.6 crore rupees back in FY19. While approvals for reduction in receivables corresponding to discounts of 330.49 crore rupees were obtained, approvals for the remaining 183.16 crore rupees are still pending. The auditors state they are unable to ascertain any consequential effect of this on the financial statements. Second, with respect to the provision for expected credit loss or ECL on these overdue overseas trade receivables. While the company has computed and applied a cumulative ECL of 265.10 crore rupees, the auditors, despite no realization from these receivables and considering the initiation of legal recovery, are unable to examine the adequacy of this ECL provision and its consequential impact. Third, a portion of the company's inventory is under the custody of secured lenders due to orders from the DRT/DRAT and is not physically accessible for verification by management or the auditors. The inventory valuation is based on management's determination of net realizable value or cost, whichever is lower. The auditors have relied on this management certified valuation.
Those are substantial qualifications. How does management respond to these in their statement on the impact of audit qualifications?
In their statement, management essentially says the impact of these qualifications is not applicable, or they are unable to estimate the impact. For the discounts on export receivables, they state it was a one-time discount due to genuine business problems faced by overseas buyers, and they don't expect material penalties. For the ECL on receivables, they are in touch with buyers and confident of recovery. For the inventory, they state its valuation is as per accounting standards and its non-accessibility doesn't mean its valuation is different. The auditors, however, reiterate their qualified opinion.
So there's a disconnect there. Did the auditors highlight any emphasis of matter points in addition to the qualifications?
Yes, they did. The emphasis of matter paragraphs highlights several items we've already touched upon. The delay in receipt of export proceeds, the same 1,512.03 crore rupees, the joint settlement agreement with lenders and the accounting for finance costs, the preferential allotment of equity shares to lenders, the preferential issue of warrants and their subsequent conversion into equity, and the adjustment of the unpaid income tax liability against refunds and recognition of interest income thereon. The auditors clarify that their opinion is not modified in respect of these emphasis of matter items.
It seems the auditors want to draw specific attention to these significant transactions and balances, even if they don't further qualify their opinion on them. What about the other matter section in the consolidated auditor's report regarding subsidiaries?
In the other matter paragraph for the consolidated results, the auditors note that the consolidated financials include the audited financials of its subsidiaries. For the year ended March 31st, 2025, these subsidiaries reflected total assets of 192.32 crore rupees, total revenues of 1.35 crore rupees, a total net profit after tax of 2.61 crore rupees, and a total comprehensive loss of 1.41 crore rupees. The auditors state their opinion on the consolidated results concerning amounts and disclosures for these subsidiaries is based solely on the reports of other auditors.
So, considering the strong reported turnaround, the significant balance sheet restructuring, but also these very serious audit qualifications, what's the overall outlook and what are the key risks for PC Jeweller?
The reported financial turnaround and the debt reduction are positives on paper. The company has managed to navigate a very challenging period with its lenders. However, the qualified opinion from the auditors is a major concern. The uncertainty around the recoverability of substantial export receivables, the adequacy of the ECL provision, and the verification of a portion of inventory cannot be understated. These issues could have a material impact on the financials if provisions need to be increased or write-offs occur. The negative operating cash flow in FY25 is another risk. The company needs to convert its reported profits into actual cash. The success of the JSA is crucial, but the underlying operational health, especially concerning those old receivables, remains a key risk. As a standard disclaimer, we advise investors to check with certified experts before taking any investment decisions.
This has been a very detailed analysis. So, to conclude, PC Jeweller has shown a significant financial improvement in FY25 with a healthier balance sheet due to restructuring. However, the auditor's qualifications cast a significant shadow over these results, particularly concerning receivables and inventory.
Exactly. While the headline numbers show a turnaround, the depth of the auditor's qualifications, especially their persistence, suggests underlying issues that need careful consideration. The company's ability to resolve these legacy receivable issues and generate sustainable operating cash flow will be critical going forward.
Thank you for breaking down these complex results for us. And thank you to our listeners for tuning in. If you found this analysis helpful, please like, share, and subscribe to our channel for more financial insights. We'll see you next time.